Okay, everybody, enormous apologies for that technical problem. We froze actually on the slide with technical problems being addressed. So I'm not going to go through all of that again. I'm sure you are familiar with those things and have read through them. So where we've gotten to is for the Executive Chairman's address. That's John Klepek, who's sitting next to me in the Fremantle boardroom. So I'll hand over to John and he can commence the informal part of the meeting.
Welcome everyone. I'm John Klepek, the Wellard Executive Chairman, and welcome to today's 2023 Annual General Meeting for the company. As with previous years, I'll provide a short Chairman's address before providing more detailed information about the operations and finances of the company in my executive capacity, alongside the company's Chief Financial Officer, Paolo Triglia. For the investors reading this speech on the ASX platform, the notes provided under each slide in the accompanying presentation provide additional information and commentary on the information presented on the slide. After 3 consecutive profitable years, unfortunately, Wellard slipped back into a loss position in 2023. A range of macro factors which combine, there's a range of macro factors which are combined to work against us in both the first and second halves of FY23. These include the historically high Australian cattle prices, which have persisted for an extended period of time and which were exacerbated in the last year when northern cattle producers send feeder cattle south rather than sustain the Indonesian feedlots. This has enabled competitors in the Indonesian market in particular to firmly now entrench their market share with alternative products and leading to very limited exports in the last year. Also, additionally, the slaughter cattle pricing has led to very limited exports to Vietnam. Market imbalances in China after New Zealand's live export ban was effective, and the high shipping fuel prices were the last piece of the puzzle that worked against us in the year just gone. Fortunately, the work in previous years provided us with a strong balance sheet on which we could draw on in FY23, with the positive volumes returning in the Brazil-Turkey trade late in the year, which we have relocated 2 of our ships to capitalise upon and which remain in that market currently. I will now move into the presentation slides. As mentioned, the overarching theme is macro factors ending our run of profits. Paolo will speak further in his commentary on the P&L and balance sheet, so I will not comment there. Shipboard performance. Voyage success rates remain a key performance measure for animal welfare. A 99.95% success rate is an excellent result and reflects the quality of our ships and the attitude and training of our crews. It also ensures, in a very tight market with excess number of ships, continued demand for our vessels for customers who want to see their cattle walk off at the destination fit and healthy for both commercial and ethical reasons. Finally, this success rate also reflects the quality of the livestock and onboard stockmen that were assembled and recruited by our exporter customers. The board is extremely pleased with our continued strong health and safety result over several years now. The health and safety of our crew has been a real focus of our board and management, and to record a 0 figure 2 years in a row is particularly pleasing given the high risk environment that we are working in. We now to keep it at that level for the 3rd year in a row. Moving on to the next slide. Flip over. There are several factors outside of our control that impacted the 23 results, and it's worth spending some time explaining them in detail. Firstly, the Australia and New Zealand have been the principal markets for Wellard charter business, and because of the downturn in volume of these markets has particularly hit us. In April 23, the live cattle trade from New Zealand was banned by the New Zealand government as a result of the sinking of the Gulf Livestock 1. So that source of charter demand is lost for the time being. I say time being as there has been a change in government in New Zealand over the weekend, and the National Party, which is now in power as one of its platforms, has promised the overturn of the trade ban and reopening of live export. So let me run through the 4 items on this slide because it's quite quick, and explain how they affected Wellard's business. The live cattle exports, which many of you on this call would be well aware of, has dropped significantly. If you look at this graph, you can see that in 2022, just 600,000 cattle were shipped, which is 40% below the 10-year average of 1.035 million cattle. The high spots of the market, the previous high spot, which corresponds with the level of herd build at the moment, was around the over the 1.2 mark if you look at 2019. And historically, that's where you would expect a return to those sort of levels. However, I'll talk further about the reasons why that is not occurring. So this obviously has reduced the demand for the total number of charters when you drop from 1 million to 600,000 and place significant pressure on charter rates for the voyages that are undertaken in this particular market. The second point is the outbreak of foot and mouth disease and lumpy skin disease in Indonesia. This has been a significant contributor to the reduction in cattle exports from Australia to our largest market. The vaccination campaign in Indonesia appears to be very effective, but has had a substantial impact on live cattle imports, some of which are short-lived, others which may be permanent. Unfortunately, this was the straw that broke the camel's back for some feedlots, which, when facing these disease issues and competition from cheaper proteins, including frozen Brazilian beef and Indian buffalo meat, have now closed down, potentially permanently. The feedlots that remain open were reluctant for much of the year to purchase large number of cattle, fearing the financial loss if a full feedlot became infected with either FMD or the LSD. As a result, their purchases have been limited and consignment sizes small, predominantly the G-class vessels, which we do not have any of. Although Wellard's larger vessels provide cost efficiency, smaller vessels are more flexible and cost effective for those smaller consignments. Just to note there, so you're talking 1,500, 1,600 head per shipment rather than 8,000-10,000 head per shipment. So it's significant smaller voyages. As we noted in our annual report, 10 voyages departed the port of Darwin in June with an average consignment size of just 1,448 head. And to put that, to reiterate this point, to put it in context, this average consignment would take up less than 1 deck on the MV Ocean Drover, leaving the remaining 8 decks empty. Alternatively, all the cattle on those 10 voyages we could have completed with one single voyage with room to spare. The third impact upon us was the timing of the Swagman breakdown and insurance claim proceeds. We noted in the half-year report that or the annual report actually, not the half-year report, that the MV Ocean Swagman had suffered an issue with its starboard engine, which that particular vessel has 2 engines, so the starboard engine has been effectively replaced completely. By the time it slow steamed to Singapore and with the new engine that was installed, the vessel was off hire for virtually 88 days. The repair cost incurred in the financial year just gone was $3.4 million US, which was included as a cost in Wellard's P&L. We have claimed the cost of the repair minus the deductible excess from our hull and machinery insurer, as well as the loss of hire. But the proceeds for this won't be paid until in the current financial year, and we are still waiting on acceptance by the insurer, but the finalisation of that is imminent. The final point of impact on the company is the bunker prices. Fuel or bunker prices remain Wellard's single largest operational cost. The very low sulfur fuel oil which we use is a key determinant of the charter rates Wellard quotes and charges its customers. Bunker prices at most ports that Wellard takes fuel on fell about 45% in FY23, except for Gladstone in Queensland, which fell by only 28%. However, they still remain high by historical standards, and recently crude oil has broken out again to the higher range above $90 a barrel. There is a very close correlation between crude oil prices and bunker prices, obviously. However, that hasn't been a linear equation in the last 3 or 4 months, which has helped us weather some of the increase in the underlying crude prices. Now I'll move on to which we put this commentary in the annual report, and hopefully it helps people, the shareholders on this call, understand the considerable movement and how we've had to adjust in the last 4 years in operating. What we try to present here is where the livestock being shipped, and so it's easy for the shareholders to understand what has changed. We monitor the livestock vessel conditions on a weekly basis to ensure we have a comprehensive understanding where vessels are positioned and their destinations. This is particularly a heat map of the routes that the AMSA accredited vessels are operating on. We also keep a track of the non-AMSA vessels, which are predominantly in the South America outward leg of the journeys, because obviously they're not AMSA approved, so they can't come to Australia. But we do keep a handle on what's going on with that capacity as well. So the trend, first trend there is the shipping capacity between Australia and Southeast Asia, predominantly our largest two markets, Indonesia and Vietnam, more than halved from January 21 to January 22 and into December 22, in line with the graph I previously showed, which showed a drop from 1.2 million to 600,000 head. So in numbers, that route represented 38% of the shipping capacity in 21, but that's fallen to 17 and 18% in the two halves just completed, or two previous halves to the one just completed. There was a small increase to 24% in the one just completed. So this directly reflects the fall in the cattle exports, which we've discussed, and is directly a product of the high Australian cattle prices and the Indian buffalo meat and frozen Brazilian beef that has stepped into the gap that has been created by the drop in Australian exports. The second trend is the market for breeder cattle to China, which is almost at a standstill currently, when just a year ago, half the AMSA accredited shipping capacity was engaged, including our drover, was engaged on this route from Australia and New Zealand. We understand currently the dairy supply chain is effectively full in China, so this is temporary rather than permanent. Our monitoring indicates activity has started to awaken on this route, but market intelligence suggests it won't return to normal until the 2024 calendar year and possibly later. The third trend, which has just turned around and now become a positive for Wellard, is there's been a significant shift to South America, with almost half the AMSA fleet deployed there from a zero base just six months ago. This has been driven by the release of approximately 500,000 import permits for cattle into Turkey. In addition to half the AMSA fleet being employed on that journey, there is a lot, the rest of the non-AMSA accredited vessels are in that region. Wellard currently has 2 out of our 3 vessels, being the Ocean Swagman and Ocean Drover, working that market. As I mentioned in the introduction, New Zealand has had a change of government. The export of dairy and some beef breeding cattle from New Zealand to China has been a large and important market for Wellard over the last 4 years. When it was banned by the Jacinda Ardern Labor Party, it had a significant impact on the Wellard business. The New Zealand nationals, which have long been a supporter of the trade and continuously committed to reopen it, which occurred last weekend when they were elected, we're looking for them to deliver on that promise very quickly. There is one important detail to mention here in the live export resumption, which should not be overlooked, and that is New Zealand National Party's commitment to what they're terming a gold standard in live export trade. This gold standard, which we have been campaigning for in Australia, with the Australian governments, both the current and the previous government, includes purpose-built vessels and what we already have here in the form of SCAS. Purpose-built vessels and an age limit on the vessels as well, in the interest of ship safety. If New Zealand brings those regulations in, they will be leapfrogging Australia in terms of safety standards. So we would encourage the Australian regulators to follow suit, or even lead New Zealand on this important issue and not lag as the leader of live export standards. Now to the slide that everyone is generally focused upon, and that is the outlook. There are some factors that emerge or emerging which has prompted some restraint early in our outlook for FY24. First and foremost, the falling live export cattle price from Darwin to Indonesia, which is definitely a positive, has failed to stimulate demand. This is partly a product of the lumpy skin disease between the dispute between the two countries, which is effectively and unfortunately shut down the trade for a couple of weeks. However, when it is reopened, importers are feeling their way through the reopening rather than reverting to the status quo. Also, buyers are being very cautious on hide conditions when they are selecting cattle, lest other conditions or blemishes such as minor as butterfly fly bites be confused for lumpy skin disease. So there's reports of up to 30 or 40% of stock that would normally go into the export markets being left on farm, on station, rather than the risk being rejected at the other end for suspected lumpy skin disease. So in a nutshell, that the trade is reopening and back to normal, so to speak, but there are conditions attached, and there is uncertainty because of that. There's a more fundamental issue that we have been talking about for several years now, and this is for the Indonesian feedlotters that have remained in business following the high Australian prices. And that's the competition from frozen beef from the Brazilian processors and buffalo meat from India. They are now firmly entrenched in that market, and even at today's prices remain at lower price points than the Australian cattle. This further restricts the ability of Indonesian feedlotters to buy in large amounts of live cattle. In context there, the feedlot capacity was in the region of 700,000 to 800,000 head. That is now, our estimates put that around 300 to 350. What we are looking for is the very low pricing of the very low pricing of the very low pricing that currently exists to translate into stimulating entrepreneurs in Indonesia to reopen feedlots and increase the capacity back up. That would entail some investment by the Indonesians, but similar to where we were in the past at prices sub $2 or sub $2, and in US dollar terms at 120, that is an attractive proposition for a feedlot operation in Indonesia. So we'd expect some entrepreneurial activity to kick in there and increase volumes, but that takes time. Vietnam, the low prices for slaughter weight cattle, that market has been completely shut or for virtually 18 months. Our Ocean Newt has done multiple voyages in the first quarter of this year to that market, so that is a positive that is returning, and that is purely because of the low price, as you know, the slaughter weight cattle is at an even lower price point than the feeder lot cattle, and that is very attractive for the importers in Vietnam. The third market, which has been the most positive for the first quarter of this year, is Turkey, with the 2 vessels located on that route, and this is looking forward. This is a very important market for Wellard. We are looking to see whether Turkey will release further import quotas as it fights significant food inflation in the country. Turkey has absorbed large numbers of imported cattle and therefore charter capacity, so it's now a waiting game to see what the future holds for calendar year 2024. So in light of all the previous slides, what does this all mean for Wellard? Put very simply, Q1 is okay with all vessels chartered for nearly all of the quarter, which is completely different to the last 2 quarters of the financial year 2023. There has been a gap at the start of Q2 for the Ocean Drover. However, in the medium term, all 3 of our main markets, Australia to Indonesia, Australia to China, and South America to Turkey, do have some question marks, as does the possible resumption of New Zealand live exports and Australian exports for dairy cattle to China. So basically, there's 4 markets. In a nutshell, there's 4 markets that we operate in. We need 2 of those going to see all 3 ships moving. If only one of those markets has a volume, we have a spare capacity. If 3 or 4 of the markets are moving, we would have undersupplied capacity. So, and basically in the last year that's gone, one of those markets has been operating, and the second, third, and fourth markets have fallen away. So we need to hit the point where 2 of the markets are moving at the same time, and all 3 ships are fully occupied, and then in that scenario we can have some pricing power brought back into the game rather than being a pure price taker. So with respect to our fleet going forward, the current time charter on the Ocean Swagman expires in the first quarter of next year, or in Q3 for FY24, and as we've mentioned in several releases, the delivery of the legal title to the Ocean Drover remains subject to Retura reaching agreement with URB to discharge the mortgages. The answer to all these questions ultimately determine our operational and financial results for FY24. I will now hand over to our CFO, Paolo, to provide an in-depth look at our FY23 financial results. Over to you, Paulo.
Okay, so in my part of the presentation, I would like to review the key financial highlights from Wellard 2023 annual report and try to put our result in a right perspective, because as John said, the economic environment in which we had to operate was one of the worst in the history of our industry. I opened the presentation with a profitability analysis, starting with a graph that show a 4-year review of revenue, cost of goods sold, and gross profit, all of which are a critical indicator of every company profitability. The first crucial point is that in financial year 2023, revenue represented by the blue column dropped 14%, mainly because of the decreased vessel activity that John mentioned before. This was due to several negative factors, most of which were outside our control, including a very tough export condition, the time lost due to COVID-related crew change deviation, and a 98% increase in technical off-hire, which included 42 days for the youth mandatory dry dock and 88 days due to the Swogman breakdown and the dry dock. At the same time, the cost of goods sold, instead of an expected decrease, rose by 26.5%, causing gross profit and gross profit margin to fall just below zero. Therefore, in the next slide, I will try to provide a better understanding of the composition of the cost of goods sold and the contribution of the chartering activities. So next slide, please. So the two graphs in this slide show the year-to-year changes in variable and fixed operational cost, giving a better understanding of the key driver of gross profit and chartering contribution, which are both presented as green bars. As you know, contribution is the difference between revenue and variable cost, and is critical because it shows the net profit available to cover fixed cost. For Wellard, the specific case, contribution is the difference between chartering revenue, bunker cost, and port expenses. And the main observation from the two charts is that is the $9 million reduction in contribution recorded in financial year 2023 due to a 14% decline in revenue and a 50% increase in bunker costs. This major drop made it impossible for Wellard to cover both vessel OPEX and the one-off extra cost of $3.4 million for the Swogman breakdown repair, without the possibility for us to include in this financial year the proceed from the insurance claim, which is expected now in this second quarter of the year. As it can be seen, OPEX also increased by about 15%, which is almost a $2 million increase as a result of an increased inflationary pressure and COVID-related extra costs. So in summary, while we could have expected a drop in bunker cost because of a reduced fleet activity, the total bunker cost increased by $2.6 million, suggesting that the main factor driving 2023 operational losses was the significant increase in fuel price, and we will see this in the next slide, please. So the graph in this slide show the dramatic increase in fuel price over the last two financial years, particularly in the second half of financial year 2022 and the first half of 2023. The blue line shows the fuel price in Singapore, one of the most competitive fuel ports in the world. The green line represents how Wellard paid every metric ton of the bunker consumed. It can be noticed that even if the two lines follow the same trend, the green line has higher value and a sort of time lag. This is because our vessel purchase fuel in different ports alongside their trading routes, which include low-cost ports like Singapore and much more expensive ports like those in Indonesia and Australia, where the fuel price reached $1,400 per metric ton last year. Moreover, because the bunker costs that flow into our income statement follow the first in, first out method, despite the decline in bunker price in the second half of 2023, Wellard bunker costs remain extremely high throughout the entire financial year. However, what can be easily seen from the graph is that during financial year 2023, Wellard recorded bunker costs at an average price of $841 per metric ton, which is nearly 18% higher than the price of the fuel consumed in 2022 and 80% higher than the one consumed in 2021. Maybe it's interesting to notice that if we put this in perspective, by purchasing low sulfur fuel in financial year 2023 at the same prices as seen in 2022 and 2021, we could have saved about $3 million and $8 million respectively. So next slide, please. So this slide concludes my investigation on profitability. Looking at the graph, we can see revenue and contribution represented by the blue and green columns. But the focus must be on the two lines. The red line represents the percentage of revenue spent on bunker and show that in financial year 2023, despite a reduced ship activity, the sharp increase in bunker cost resulted in a 50% revenue erosion. When the previous year was, the previous 3 years actually, average was 33%. This mainly happened because as bunker cost started its huge rise to December 2022 level, Wellard were forced to absorb a large portion of this increase when our customer reached their maximum payment capacity. The orange line instead represents the contribution margin ratio, which in simple word is the percentage of revenue left after covering variable cost. Also here, we can see that contribution margin fell from 64% in financial year 2021 to 43% in financial year 2023. So in conclusion, the graph highlights two important points. One, that the main reason for the poor financial result in financial year 2023 was a drop of contribution. And second, the primary cause of this drop was the massive increase in bunker price, which was behind any possibility of control. On the other side, it also suggests that normal bunker price could drastically improve Wellard future profitability. So next slide, please. So what we learned so far from the previous slide is supported by a look at the bottom part of our income statement, where most costs have either remained stable or decreased over time. Group overhead were reduced by 17% to $3.8 million. This was crucial in limiting our EBITDA losses to $4.4 million, which came after 5 consecutive years of positive EBITDA result. Depreciation and amortization increased by 0.4%, which included the $1.9 million cost of the Swogman dry dock. Moreover, by repaying completely all ship loans, we reduce our net financial cost by 71%, bringing them down to just $200,000 this year. And the last chart shows our reported net losses after tax of $15.5 million, making a real shift after 3 years of upward trends. So next slide, please. In this slide, I would like to highlight briefly some one-off material costs that, in addition to the challenging market and global economic condition have had a unique impact on Wellard financial result and put those one-off costs in relation to this year losses. First is the $3.4 million engine repair of the Ocean Swogman, as I said, not counterbalanced by the proceeds from the insurance claim. Second is the $1.9 million dry dock cost of the Ocean Swogman, which were initially capitalized, like we usually do, and later fully recognized in the income statement in one shot due to the short-term charter renewal of the vessel. And lastly, $700,000 related COVID cost, which during financial year 2023 still caused disruption in shipping industry. Additionally, impacting the financial year 2023 results, where there was the repositioning of Ocean Drover and the Ocean Swogman to the South America to Turkey trade, which resulted in increased cost and loss of time during the long ballast passage. So next slide, please. Now, if we change focus on last asset and liabilities, we can see that Wellard balance sheet was able to withstand the poor result of the financial year just ended. After the repurchase of the Ocean Youth and the complete repayment of the loan of the Ocean Drover, there are no further payments that need to be done to Ruchira, and there are no ships loan outstanding. Loans and borrowing reduced by 66% and are now $2.6 million, which is only for the rolling facility in place for the purchase of bunker. And we closed the financial year with a negative net debt position of $4.8 million, which actually means net cash in hand for the company and a working capital of $3.2 million. Next slide, please. So my presentation ends with a very short analysis of the cash flow. In financial year 2023, cash flow from operating activity generated a cash flow of $1.5 million after taking into account $2.4 million outflow for the payment of the Swogman repair. This drove our cash conversion ratio to fall to 3.4%. The net outflow from investing activity was $3.7 million paid for the dry docks of the two vessels. The outflow from the financing activity mainly relates to the repayment of borrowing and lease. And finally, as you can notice, the total decrease in cash was $7.7 million, which is much less than the $15 million losses, given the large amount of non-cash items, mainly vessel depreciation, that impacted our income statement. And we ended up the financial year with a cash in hand of $15.3 million as of, $7.4 million as of 30 June. And actually, this concludes my financial review, and I will now hand back to John, who will run the formal matters for a resolution at this meeting.
So we now move on to the Q&A section of the agenda before moving on to the formal part of the meeting. I'll open the floor and online platform to questions. If you have any questions relating to presentations, ask them now. If you have any questions relating to the resolutions, leave them to when we get to the resolutions, and we'll give you an opportunity to ask the questions for the particular resolution as we get to it. If you're a shareholder and want to type a question, please do so in the questions box on your screen. If you're a shareholder and want to ask a question verbally, please use the raise the hand icon on the platform. Our auditors, Moore Stevens, are also in attendance to answer any questions that you may have of the accounts. So I'll pause there for a moment just to see if there are any questions on the platform via hands raised or via typed questions.
Yes, there are, John.
Okay.
So our first question is from Graham Castlehow, and his question is effort still being put into influencing international standards so that only high standard vessels can be used to transport stock?
Good question, Graham. We've gone down the path. Look, Wellard historically and still are the leaders of the pack in this regard. We're the first for animal welfare moves on the ship, and ship safety has always been our #1 priority ever since this company, even as a private company, and since it's been public. The process to change international standards is very long, and it starts with your home country, in particular AMSA, and we've lobbied rigorously with the previous ministers, both transport and agriculture minister of the Liberal National Coalition, and with the current agriculture and transport minister of the Labor government. We haven't made headway as much as we would like. We're campaigning for purpose-built vessels and limited life and minimum airflow standards. The position of the Australian government currently is that we're the leaders of the pack. There's nothing to look at here. We're happy with what the standards are. We don't believe that, as we see with New Zealand. New Zealand, as an example, the Gulf Livestock 1, which lost all its crew and all its cargo, was an AMSA accredited vessel, and that had done trips from Australia before that incident where it occurred with the New Zealand cattle. So our position has been to the Australian government before going to the international government that could very easily have had Australian cattle on board and left one of the Australian ports, and the same outcome would have occurred. It's not good enough to sit on your hands. You need to continually increase and raise the bar, and the overlay also with that are sustainability in terms of fuel, etc., going into the future. So when we've had the conversation with AMSA, they're basically fully got a full workload. The time and effort that's needed to go into lobby for an IMO change of standards, you need a lead country to do it. It's a 10-year time frame, and there will be parties that will be against it, and there's a lot of lobbying that has to occur by the lead country. We've looked at potentially having some European countries which are more attuned to animal welfare and ship safety than some other countries take the lead on this. But as of yet, we haven't had any movement. But without a question, there are the same thinking that occurs in the Australian market and New Zealand market is starting to happen overseas markets, in particular the European markets where it's becoming front of mind. So there are, and look, you can have regulations come over the top, or you can have the industry players take the lead on this and demand higher standards. And that's one area where we've been particularly disappointed with. If I note on the record, the Australian producers have always looked to price and price alone when choosing who to export cattle and sheep with, when they should be looking at the record of the ship safety and animal welfare on that ship, rather than, oh, this bloke's giving me an extra 1 cent a kilo for my load.
Great, thanks, John. Next question is from Jason Hodgwell-Jones. Given the precipitous falls in the EYCI, would you consider reactivating cattle trading business using the export license still in place?
Short answer is no. We are firmly ship charterers. The exporting is, as I said, the feedlots are currently full in Indonesia. And the exporters that are involved in that market currently are only doing the G class, the 1,1500 head shipments, because of the risk involved. If a shipment goes across and it gets rejected for LSD, even if there's 3 or 4 cattle on there, it's a high risk business. Admittedly, yes, the margins would be attractive. This is the time when Wellard historically did make money in that game. So we look to our live export charterers of the ship. They're sufficiently covered in the market, and we don't want to cross across and start competing with them. So the relationships we've built up with several live exporters puts us in good stead going forward, so we don't have to cross over into that area. So short answer is no, because the market still has sufficient players there, and we believe chartering is a specialist operation. As you can see, the 4 markets that we've had to be quite nimble to move around. As one closes, we've had to move the ships around the other side of the world to capitalise on opening over there. Going forward for us, we want 2 of those 4 markets to have high volumes, and we'll be happy days. But unfortunately, we've been struggling with only 1, and sometimes even none. So we look forward to better times there.
Thanks, John. And follow-up question from Jason. What is the stance of management in terms of the use of the bunker hedging facilities, given the significant bunker fuel volatility over the past 2 years?
Excellent question. We've looked at that several times, and when the oil price collapsed at the beginning of COVID, we did look at locking in when the price went down to sub 20 US. However, the forward hedging on that was quite a gap. So it was the risk return wasn't there. So it's more of a case of locking in when prices get low, because you wouldn't lock in at there's no point locking in at high prices. But it is something we constantly monitor, and if it gets into an area where we think it's underpriced and it will come back, you've seen Paulo's slide shows how significant bunker price affects the business. So if we could lock in at a lower price, it would be a positive. However, the flip side of that is you are risking, as with any hedge, if it goes the other way, you're on the wrong side of it. So we're in the business of chartering ships. Not at the end of the day, we're not forex speculators, or crude oil speculators. But having said that, as I said, there was opportunities at the beginning of COVID, which we look back in hindsight, and it was only purely because the number of people that were willing to offer a forward hedge was limited, and the players in that market didn't have the players that were willing to offer a competitive hedge. There was question marks about the counterparty risk. So yes, we've looked at it and we will continue to look at it, but you need to weigh everything up. And especially back at that time, there was a major trader in Singapore that went to the wall owing several $1 billion, and that was one of the parties that were willing to offer us a hedge. So we have to balance everything up, basically, but it is something we constantly look at, and it does fluctuate. Just look at the oil price graph for the last 5 years. Anything in excess of $90 plus is pain. If it gets under the $50 mark, it's good. But interesting point on that, the crude oil price used to translate directly into bunker price. Because of other things at play, that hasn't flowed through directly. We would be seeing higher bunker prices with crude oil prices up around that $90 mark again than what we are actually currently seeing. So there's more competition in that area, which has shielded us from the brutality of some of the increases that we've had in the past.
Great, thanks, John. There are no further questions on the presentation.
Thank you. Thanks for some very good questions there as well. No further questions. I shall move on now to the formal part of our AGM and ask our Company Secretary, Michael Silbert, to take over the running here, since I've said quite a bit already.
Thanks, John, and thank you everyone for your patience through our technical issues this morning. As you'll have seen in the notice of meeting, there are 3 items on the agenda. We'll take questions relating to the agenda items as they arise, and we'll address other questions at the conclusion of the meeting. Note that the notice of annual general meeting has been distributed, and we will take that as read. There is a thorough explanatory memorandum section in the notice of meeting which provides details about each agenda item and resolution. Voting in this meeting and under our constitution is by poll. We've set out the process in detail in the notice of meeting. We've already received voting by proxy, and following are some important things to help you manage your voting. This slide is largely unnecessary because we haven't received any emails or indications either up to the deadline or post that anybody will be voting in this meeting, which effectively means that participants have pre-lodged their proxy forms. So with the chairman's permission, I'll just skip forwards to agenda item 1. And agenda item 1, as you can see there, is on the screen. It's not a voting item. It's a question of whether there's any further discussion or questions relating to the annual report. We remind you that Mr. Pace from Moore Stephens is present at the end of the table, but not quite visible on our camera, and happy to take any questions on the accounts. So again, those same processes, or type in a question and we'll get to it in due course.
No questions have been received, Michael.
All right, thanks for that. So the text of the resolution is displayed for resolution number 1. This is a voting item, and we'll display in 1 second the proxies received in respect of the resolution. Voting prohibitions apply to this resolution, and we'll open for any questions on the resolution.
There are no questions received.
Okay, so if I go then to the display of the proxies received, it does appear, whilst this is an ordinary resolution and passes with a 50% vote, it appears that 25% or more shareholders who have lodged proxies have voted against resolution 1. Assuming this is confirmed at the end of the meeting after the poll, it means that the company will receive a first strike and will be required to include a contingent resolution in next year's 2024 annual general meeting to account for the possibility that it may receive a second strike. You can see there that proxies received represent 69.93% of the company's issued capital, and we would have avoided that first strike at 75%. I don't think there's much else to say in that respect. If you haven't lodged a proxy, or if you're voting during the meeting, or if you have any issues with that, please either raise your hand or type something into the chat for the meeting.
There are no questions, Michael.
Okay, thank you. The chairman will vote those open votes, 183,000 in favour, as we had stated in our notice of meeting. The second formal voting item, resolution number 2, is the re-election of Director Mr. Philip Clausius, who retires by rotation. The text of the resolution is displayed on the screen. This is a voting item again, and in a moment I will display the proxies received. You've already received information about Mr. Clausius, who is an independent and non-executive director of Wellard, in your explanatory memorandum section of your notice of meeting. And again, happy to raise any questions or receive any questions on this resolution. Whilst I wait for that, I'll display the proxies received. And in this respect, we can see the proxies are in favour of the resolution. We've received proxies representing 69.95% of our company's issued voting capital. So that passes.
There are no questions.
No questions on that, that's great. And that passes with an 86.2% support level, so thank you for that. Votes are being determined by a poll, and we will collate, audit and release those results after the close of the meeting. I don't anticipate they will change a great deal from the results that we have already displayed to you. However, we'll allow some time for shareholders to raise any issues or complete any voting if they feel that they have missed that opportunity. The poll will remain open, and I'll now hand you back to Executive Chairman John Klepek.
Thank you, Michael. In closing, I'd like to thank our shareholders for the continued support of the company, particularly in light of the difficult FY23 year. We continue to benefit, Wellard continues to benefit from a robust cash position and balance sheet so that we are positioned for a market turnaround. It is important that we again acknowledge Wellard's hard-working team onshore and on vessels. They worked extremely hard, whether they're loading livestock, monitoring our engines, or working the phones for new orders. And finally, I want to thank our customers. They remain extremely important to us, and we appreciate their continued loyalty. We're looking forward to FY24 and beyond. Thank you.